Every economic collapse in history follows the same six-phase pattern. The timeline changes, the trigger changes, but the sequence never changes. In 1929, Phase 1 lasted 8 years before the crash. In 2008, Phase 1 lasted 4 years. In Venezuela, Phase 1 lasted a decade. But once Phase 2 begins, the timeline compresses. Phase 3 arrives in months, not years. Phase 4 happens in weeks, and Phase 5 can materialize overnight. Right now, in January 2026, we're in Phase 2. The people who recognize that have maybe 6 months before Phase 3 makes preparation impossible. Here are the 6 phases every economic collapse follows, the historical pattern that repeats regardless of country or century. Because if you don't know which phase you're in, you can't time your decisions. And timing is the difference between those who preserve wealth and those who lose everything. If you want to understand where we are in the collapse timeline and what comes next so you can position before the window, closes, hit subscribe now. I break down the phase patterns that repeat across every major collapse. The sequence they don't teach you, but that determines who survives and who doesn't. Phase 1. Artificial stability built on debt and denial. The calm before everyone realizes it's not calm. Phase 1 is where most people think the economy is fine. Maybe there are problems, but they're manageable. Growth continues, even if it's debt-fueled. The stock market hits new highs. Real estate prices climb. Unemployment stays low. And anyone who warns about systemic risk gets dismissed as a doomsayer. Here's what's actually happening during Phase 1. The foundation is cracking, but the facade looks perfect. Debt accumulates faster than income. Asset prices disconnect from fundamental value. Central banks keep interest rates artificially low to maintain the illusion of growth. And the people benefiting from the bubble insist everything's sustainable. During the 1920s, Phase 1 ran from 1921 to 1929, 8 years of apparent prosperity built on margin debt and speculation. When margin debt hit record levels in 1928, economists declared a new era of permanent prosperity. The crash came 18 months later. In the 2000s, Phase 1 ran from 2002 to 2006. Housing prices climbed 50% while wages stayed flat. Lending standards evaporated. Subprime mortgages got bundled into AAA-rated securities. And Federal Reserve Chairman Ben Bernanke testified in March 2000 that subprime was contained and wouldn't affect the broader economy. The crisis peaked 18 months later. In Venezuela, Phase 1 lasted from the early 2000s through 2012. Oil revenue masked economic mismanagement. The government spent borrowed money on social programs that won elections but created no productive capacity. When oil prices dropped in 2014, the foundation collapsed. But during Phase 1, anyone questioning sustainability was labeled a capitalist trying to undermine the revolution. Here's what separates Phase 1 from normal economic cycles. During normal cycles, debt grows but gets serviced by productive economic activity. During Phase 1, debt grows faster than the economy's ability to service it. Asset prices inflate beyond what fundamentals justify. And the consensus insists this time is different. Some new factor, technology policy, makes old rules obsolete. That consensus is always wrong. The United States entered Phase 1 around 2010 after the 2008 crisis. Federal debt went from $10 trillion to over $36 trillion. Stock markets tripled while GDP grew 30%. Housing prices in major cities doubled while wages increased 15%. The disconnect between asset prices and economic reality widened every year. And every year, the consensus insisted the recovery was real, sustainable, and justified the valuations. Phase 1 ends when insiders start recognizing the bubble can't continue. Not the public, insiders, the smart money that sells to the dumb money before the crash. Phase 1 ends when reality becomes undeniable to people who understand how systems actually work. That transition is Phase 2. Phase 2. Insider recognition and quiet repositioning, where we are right now. Phase two is when people who understand economic systems recognize the collapse is inevitable and begin positioning defensively. This isn't public knowledge. Markets haven't crashed. The media isn't declaring crisis. Most people still think phase one stability is real, but insiders are selling assets, moving money internationally, buying hard assets, and quietly preparing for breakdown. Here's what defines phase two. Visible cracks appear that can't be ignored by informed observers. Regional banks fail, commercial real estate vacancies hit records, government debt reaches levels that can't be serviced without printing money, and the people with access to real data, not public statistics, recognize the math doesn't work anymore. During 1928 and early 1929, Phase 2 emerged when informed investors started exiting positions. Joseph Kennedy reportedly sold all his stocks in early 1929 because a shoeshine boy gave him stock tips. When taxi drivers are speculating in markets, professional investors know the bubble is terminal. They sold quietly to avoid triggering panic. The public kept buying until September 1929. In 2006 and 2007, Phase 2 showed up as increasing mortgage defaults and the collapse of subprime lenders. Bear Stearns hedge funds failed in July 2007. Countrywide Financial nearly went bankrupt in August 2007. These were clear signals to anyone paying attention. But housing prices kept climbing until mid-2007. The stock market hit a peak in October 2007. The public didn't recognize crisis until Lehman collapsed in September 2008, 15 months after insiders knew the system was broken. In Venezuela, Phase 2 ran from 2013 through 2015. Inflation accelerated, shortages emerged, foreign reserves depleted. The wealthy moved money offshore, international investors divested, but the government insisted everything was fine. Official inflation numbers were manipulated, and most citizens believed their currency would stabilize because they couldn't imagine hyperinflation happening to them. Here's how you know we're in Phase 2 right now. Regional banks are failing. Silicon Valley Bank, First Republic, Signature Bank in 2023. Commercial real estate is selling at 50% discounts with no buyers. Office vacancy in major cities exceeds 30%. The $1.8 trillion in commercial loans maturing can't refinance at current values. Federal debt requires over $1 trillion annually in interest payments, and the smart money is moving to hard assets, international diversification, and defensive positions. The public doesn't see it because markets haven't crashed yet. The S&P might even hit new highs on the way down, just like it did in October 2007. Unemployment still looks manageable in official statistics. The media reports economic resilience, but the underlying structure is collapsing in real time. Phase 2 is the period where informed people recognize reality while the consensus denies it. Phase 2's duration varies. Sometimes it lasts months, sometimes years. The 1929 crash had maybe 12 to 18 months of Phase 2. The 2008 crisis had roughly 15 months from Bear Stearns to Lehman. Venezuela had 2 years. The key is recognizing when Phase 3 starts, because once it does, the timeline compresses dramatically, and Phase 3 starts when public awareness forces institutional response. Phase 3, public awareness and initial panic, the moment everyone realizes at once. Phase 3 is the transition from insider knowledge to public panic. Something happens that forces mainstream acknowledgement of the crisis. A major bank fails. A government admits insolvency. A currency drops 20% in a week. Whatever the trigger, Phase 3 is when the average person realizes the economy isn't recovering, it's collapsing. Here's what happens during Phase 3. Bank runs begin. People rush to withdraw cash. Stock markets experience violent swings. Retail investors panic sell, trying to salvage anything. Governments make emergency declarations. Central banks slash interest rates or implement unprecedented interventions. And the consensus shifts from everything's fine to how did this happen so suddenly? During 1929, Phase 3 began with Black Thursday on October 24th, then Black Tuesday on October 29th. The market lost 25% in 2 days. 12 million shares traded hands when normal volume was 3 million. Banks failed, brokers went bankrupt, and the public finally understood that the prosperity of the 1920s was built on margin debt that couldn't be sustained. In 2008, Phase 3 crystallized when Lehman Brothers filed for bankruptcy on September 15, 2008. AIG required a government bailout the next day. Washington Mutual failed. Wachovia nearly collapsed. Within 2 weeks, the entire financial system was on the brink. Money market funds broke the buck. Credit markets froze, and the public went from believing housing prices would stabilize to fearing total economic collapse. In Venezuela, Phase 3 hit during 2016 and 2017. Inflation became undeniable, grocery stores emptied, the government admitted food shortages, the Bolivar lost 95% of its value, and citizens who had believed official statistics suddenly understood their money was worthless. Phase 3 is when reality overwhelms propaganda. Phase 3 typically lasts weeks to a few months. It's the period of maximum volatility and confusion. Governments try interventions. Some work temporarily, most fail, and the public oscillates between hope that authorities will fix everything and fear that nothing can be fixed. During Phase 3, preparation becomes difficult because everyone's competing for the same resources. If you wait until Phase 3 to act, you're late. The transition from Phase 2 to Phase 3 is what you need to watch. Right now, we're in Phase 2. The cracks are visible to informed observers, but not mainstream consciousness. Phase 3 starts when something forces mainstream acknowledgement, a major bank failure that can't be contained, a currency event, a geopolitical shock that breaks already fragile systems. When that happens, the 6-month window between Phase 2 and Phase 3 closes overnight. Phase 4, institutional breakdown and government response when the rules change. Phase 4 is when established institutions stop functioning normally and governments implement emergency measures that would have been unthinkable during Phase 1. Banks limit withdrawals. Capital controls restrict money movement, price controls attempt to fight inflation, and the government seizes assets or implements policies that violate previous legal norms. Here's what happens during Phase 4. The government's priority shifts from maintaining normalcy to maintaining control. They don't care about your rights or property. They care about preventing total collapse of authority. That means restrictions on banking, movement, trade, and asset ownership. It means confiscation dressed up as emergency powers, and it means the rules you planned around no longer apply. During the Great Depression, Phase 4 included Executive Order 6102 in 1933, which required all citizens to surrender gold to the government at fixed prices. Owning gold became illegal. The government confiscated citizens' wealth to stabilize the banking system. That's Phase 4. Legal protections disappear when governments decide emergency conditions justify anything. In 2008, Phase 4 involved TARP bailouts, quantitative easing, and zero interest rate policy. The Federal Reserve expanded its balance sheet from $900 billion to $2.2 trillion in months. They bought assets that had no market. They backstopped institutions that would have failed. The government decided which companies survived and which died. During Phase 4, the free market stops existing. Government intervention determines outcomes. In Venezuela, Phase 4 meant price. Controls, currency controls, nationalization of industries, and criminalization of holding dollars. The government arrested people for having foreign currency. It confiscated property from anyone deemed an enemy of the state. It banned criticism of economic policy. Phase 4 is when governments abandon rule of law to maintain power. Phase 4 lasts months to years depending on government effectiveness and economic severity. During this phase, official narratives and reality diverge completely. Inflation runs 20%, but official statistics report 5%. Unemployment hits 15%, but the government reports 8%. And questioning official numbers becomes dangerous because governments in Phase 4 need the illusion of control. The key for survival during phase 4 is having already positioned assets outside government reach, international accounts, precious metals stored privately, property in jurisdictions with different governments. Because once phase 4 starts, moving assets becomes illegal or impossible. The people who positioned during phase 2 survive phase 4. The people who waited lose everything to confiscation disguised as national emergency. Phase 5. Currency collapse and barter economy when money stops working. Phase 5 is when the currency loses most or all of its value. Hyperinflation makes cash worthless. People refuse to accept it. Barter becomes the primary exchange method. Prices change hourly. Stores won't hold merchandise. Wages are worthless by the time you get paid. Everyone tries to exchange currency for anything tangible immediately. Germany's Weimar hyperinflation hit phase 5 in 1923. Prices doubled every few days. Workers got paid twice daily and rushed to spend before money lost value. A loaf of bread that cost 250 marks in January cost 200 billion marks by November. Zimbabwe reached phase 5 in 2008. The government printed $100 trillion notes that bought maybe 3 eggs. People refused Zimbabwe dollars entirely. Trade happened in U.S. dollars, South African rand, or direct barter. Venezuela entered phase 5 around 2018. The bolivar lost 99.99% of its value. Inflation hit 1,000% annually. People carried backpacks full of cash to buy groceries, then stopped using bolivars altogether. Phase 5 is less likely for the dollar as global reserve currency. The U.S. is more likely to experience extended phase 4 with high inflation and capital controls rather than full hyperinflation. However, phase 5 can happen locally. Cities can enter phase 5 conditions while federal systems maintain function. New Orleans, after Katrina, showed this. Money stopped working locally even though the national economy functioned. Phase 6. Stabilization and new normal. After the collapse settles, phase 6 is when chaos stabilizes into new equilibrium. Currency might be replaced, government might change, economic structure transitions, the collapse is over and a new normal emerges, always worse than phase 1 for most people, but stable compared to phase 5. Survivors adapt. Wealth has been redistributed, some positioned correctly and gained, and the new system establishes itself until the next collapse cycle begins. After the Great Depression, phase 6 took years. The New Deal created new government structures. World War II reset the economy. By 1945, a fundamentally different economic order existed. After 2008, phase 6 arrived. By 2010, the economy stabilized at a lower level, but the new normal included permanent quantitative easing, zero interest rates, and massive government debt. That became the baseline for the next cycle. After Weimar, Germany issued the Rentenmark to replace the worthless papier mark. Hyperinflation ended, but political chaos from the collapse enabled extremism that led to World War II. In Venezuela, phase 6 hasn't fully arrived. The economy partially dollarized. Some stability returned, but political crisis continues. Phase 6 is what you're trying to reach with wealth intact. The people who recognized phase 2, positioned during phase 3, survived phase 4, and navigated phase 5, enter phase 6 with advantage. Why knowing the phases matters more than knowing the date. Everyone wants to know when the collapse happens. That's the wrong question. The collapse is a process, not an event. Right now, in January 2026, we're in phase 2. That means the collapse already started. Most people don't realize it because they're looking for a phase 5 event. They're waiting for hyperinflation or bank runs or currency collapse. But those are late phase indicators. The people who survive collapses with wealth intact recognize phase 2 while everyone else is comfortable in phase 1. They position defensively when positioning is still possible. They don't wait for phase 3's public panic. By then, preparation becomes difficult and expensive. They definitely don't wait for phase 4's government restrictions. By then, moving assets is illegal. Here's what you need to understand about phase timing. Phase 1 can last years or decades. Phase 2 can last months to a couple years. Phase 3 lasts weeks to months. Phase 4 lasts months to years. Phase 5 might not happen at all for major currencies or might last years for smaller currencies. Phase 6 eventually arrives and establishes new normal. But the transitions between phases accelerate. The gap between Phase 2 and Phase 3 is longer than the gap between Phase 3 and Phase 4. Once public panic begins, institutional breakdown follows quickly. Once institutions break down, currencies can collapse within months. The timeline compresses as each phase progresses. Right now, we're in Phase 2. The evidence is overwhelming. Regional bank failures, commercial real estate collapse, unsustainable debt levels, smart money moving to hard assets. But most people don't see it because they're not looking at the right indicators. They're watching stock market indices and unemployment numbers that lag reality by months. The transition to Phase 3 could happen next month or could take another year. The trigger might be a major bank failure, a geopolitical crisis, a natural disaster, or just the accumulation of Phase 2 evidence becoming undeniable. But once Phase 3 starts, your preparation window closes, bank runs begin, prices spike, government restrictions emerge, and you're competing with millions of panicked people for the same resources. The window is now. Not because I'm selling fear, because the pattern across every historical collapse shows that Phase 2 is when informed people position. The people who wait until Phase 3 to act are 6 months late. The people who wait until Phase 4 are years late. And the people who don't act until Phase 5 never recover. Subscribe, because next week I'm breaking down the specific positioning strategies for each phase. What to do during Phase 2 while there's still time. How to recognize the Phase 3 transition. What happens during Phase 4 restrictions. And how to enter Phase 6 with wealth intact when most people lost everything. See you then.